Hello everyone, today in this video, let's understand about the Indian context in microfinance. Basically, we'll be discussing about the three major aspects, which is the structure of microfinance institutions in India and the regulatory changes after 2011, and finally, how the microfinance institutions are gradually becoming more like bank models. So, why Indian context is important? In India, financial exclusion has historically been linked with the poverty, lack of collateral, and geographical challenges. And as we are all aware, traditional banks are often hesitant to lend to rural borrowers due to reasons like higher transaction cost or perceived credit risk which they might face. So, this gap created the need for microfinance institutions. And as microfinance institutions operate with a very small ticket size and also follow the group based lending mechanisms, therefore, it can be concluded that microfinance is in India is not just about financial services, it is a development tool. So, most microfinance institutions today operate as the non-banking financial company microfinance institutions. And one important reason why NBFC microfinance institution became dominant is due to its operational flexibility. Because unlike non-governmental organizations, non-banking financial company microfinance institutions can also raise their capital via investors and financial institutions, which allows them to scale operations across multiple states. And however, they cannot accept deposits like banks. They depend heavily on borrowings, which increases their cost of funds. Therefore, sustainability depends on efficient recovery and strong portfolio quality. Moving ahead, let's now understand about the transformation which happened in the year 2010 to 11. So in India, in 2010-11, India faced a major microfinance crisis, especially in the state of Andhra Pradesh. And there were issues like high interest rates, aggressive recovery practices, and over indebtedness was seen in the period, which raised serious concerns. And after all these, RBI introduced strict regulations for the same, and these included the interest rate caps, the borrower protection norms, and income and loan limits were controlled and managed well. And the mandatory credit bureau integration was also brought into force in this period. And this regulatory framework strengthened the transparency and reduced the exploitation, which was the best part, which the issues brought up, which brought up this transformation. And today, Indian microfinance is one of the most regulated in the world. So this was about 2011, oversight of post 2011. So moving ahead with the gradual shift which happened between of microfinance institutions to the bank-like models. So over time, many microfinance institutions have started moving towards the bank-like models. Basically, they were trying to adopt stronger governance structures, professional management, and diversified funding sources. So the microfinance institutions are basically meant to ease the funding for rural people, for the women entrepreneurs, and this shift of MFIs to the bank-like models, they were trying to adopt more towards the governance structures, to adopt more of the professional management and the diversified funding sources. So they basically converted into small finance banks, such a shift allowed them to improve the scalability and sustainability while continuing with the financial inclusion in the rural segments as well. And however, this challenges maintaining social objectives along with the profitability, which is a plus point. Moving ahead, let's understand about the analytical view. So in the Indian context, microfinance has evolved from a purely social initiative because as we have already gone through the basic introduction of how Indian people adopted, what was the oversight. So microfinance has evolved a lot, and it has commercially come into the structured sector, transitioned into the bank-like structures. And the key challenge here is balancing commercial discipline along with social responsibility, which is the best combination that we could see. And if commercialization increases excessively, we can see a mission drift which can occur, that is shift from poverty elevation to profit maximization. So therefore regulation is always a balancing point, acting as a counterbalance to ensure inclusion, and inclusion remains central for all. And let's conclude the session with the major points as discussed. The India's microfinance sector is largely a non-banking finance company, microfinance institution driven, which we already understood, and this strongly regulated after 2011, bringing in the transparency and various other regulations important for the economy and microfinance institutions and funding structures as well. And gradually the transition which we saw towards structured bank-like models, making it the beneficial blend. And so the Indian context shows that sustainable financial inclusion requires a balance between commercial growth and social mission. So that's about it. Thank you.